ABA is the trade group and professional association representing the nation's banking industry. Welcome.
Chairwoman Velasquez, Ranking Member Graves, members of the committee. My name is Austin Roberts. I am Vice Chairman, President, and CEO of the Bank of Lancaster, which is headquartered in Kilmarnock, Virginia. I'm pleased to be here today on behalf of the ABA. Small businesses, including banks, are certainly suffering from the severe economic recession. This is not the first recession faced by banks. Many banks have survived the ups and downs of the economy. Mine has survived those for the last 80 years. In fact, most banks have been in their communities for decades and intend to continue to be there for decades. We are not alone, however. In fact, there are more than 2,500 banks, 31% of the banking industry, that have been in business for more than a century. 5,000 banks have served their communities for more than half a century. These numbers tell a dramatic story about the staying power of banks and their commitment to the communities that they serve. The success of small entrepreneurial businesses are very important to my bank. My bank's focus, and those of my fellow bankers throughout the country, is on developing and maintaining long-term relationships with these and other customers. In this severe economic environment, it is only natural for businesses and individuals to be more cautious. Businesses are reevaluating their credit needs, and as a result, loan demand is all. Banks, too, are being prudent in underwriting, and our regulators are demanding it. In fact, in some cases, overly restrictive rules and examinations are hampering banks' ability to make new loans. While a great deal of attention is rightfully being paid to the administration's regulatory proposal, I would like to share with you other issues that banks like mine are facing. First, the most important threat is the very high premiums being paid by banks to the FDIC. For example, my bank paid $75,000 in premiums in 2008. This year we will pay $550,000 in premiums, with the possibility of it even going to $700,000. There is no question that the industry fully backs the financial health of the FDIC, but such large expenses have a very strong dampening effect on bank lending. ABA has detailed options in a letter to FDIC Chairman Baer that meet the funding needs without creating a financial burden on banks that could reduce bank lending and hurt the economic recovery. Second, ABA continues to hear from bankers that regulators are demanding increases in capital and that banks improve the quality of their capital. With capital markets still largely unavailable, especially for community banks, the only course of action in the short run is to reduce lending in order to improve the bank's capital-to-asset ratio. Third, the recession has strained the ability of some borrowers to perform, which often leads examiners to insist that a bank make a capital call on their borrower, or impose an onerous amortization schedule, or obtain additional collateral. These steps can set into motion a death spiral, where the borrower has to sell asset sale prices to raise cash, which then increases the write-downs that banks have to take, and the cycle just goes on and on. These actions are completely counter to the notion of working with customers to make sure that credit is available to them, or working with borrowers that may even be in distress. There is much more included in my written testimony that details the difficulties that have arisen in the past year. But I want to take a moment to mention one idea ABA has to increase capital community banks in areas most hard hit by recession. Banks in these areas are doing everything they can to make credit available, but it's against the significant headwinds of losses from problem loans. The idea, which the ABA shared in a letter to Secretary Geithner 2 days ago, would be to modify the Treasury's existing capital assistance program to help well-managed, viable community banks access capital. These banks would match any investment the Treasury makes with private equity. In this way, a relatively small sum of money, say $5 billion invested by Treasury, matched by $5 billion in private equity, would bring all small banks' capitals to levels significantly higher than regulators require to be well capitalized. Having additional capital will provide a cushion for these banks to meet the credit needs of their communities rather than reducing lending to meet regulatory capital requirements. I want to thank you for the opportunity to present these views on the challenges ahead for banks that serve small businesses, and I would be happy to answer any questions.
Thank you, Mr. Roberts. Our next witness, Mr. Bill Hampel. He is the Senior Vice President of Research and Policy Analysis for the Credit Union National Association. UNA provides many services to credit unions,